Guys, 3 earnings reports due today. 2 of the companies are up over 15% on the day because they crushed. Company number 1, Home Depot, guys. Home Depot's up very little. Guys, Home Depot's expected to make $39.3 billion in revenue. They brought in $40.22. That's a pretty big beat for a company that large. They reported $3.78 in earnings versus $3.65 expected. So a double beat here. Company's not up a ton right now, only 0.4%. Hit an all-time high just last month of 421.56. But as you can see here, back in late 21, they got pretty high up there. So this is pretty close to these all-time highs here. Home Depot's a great company based in Atlanta, Georgia. Let's go break down their earnings release to take a look at it. And for you guys out there who are new to our channel, we do 3 or 4 videos a week. We talk about earnings releases, economic outlook, all these news stories that are happening in the market. And we talk about how they influence the way in which you're investing. So if you're interested in doing that, make sure you subscribe to the channel. Let's check out Home Depot's earnings release. Now, guys, what's interesting here is revenue was up 6.6% for the third quarter of 24 versus 23. But one thing that was interesting, comparable sales for this third quarter decreased 1.3%. Comparable sales is a very important metric in retail. It says, hey, on stores that have been open 12, 15, 18 months or more, how do their store sales do? This was down a lot before. And if you noticed on other videos I did, I sat there and worried about the consumer based on same-store sales at Home Depot, Lowe's, Target, because all of them had big declines in same-store sales. This is a lot lower than it was last time. But we saw a big surge in companies like Walmart. And I was like sitting there going, okay, if consumers are spending less at these kind of stores that you don't need to buy from, Target, Home Depot, and Lowe's, and they're spending more at Walmart, what does that say about the consumer? Maybe a little bit weaker than expected. For such a big revenue beat, I was truly expecting to see an increase in same-store sales, especially with an increase of 6.6% in terms of revenue for the quarter. Operating income was $5.4 billion. Operating margin was 13.5%, matching last year's operating income, but a lower margin overall. Now, even though they beat on earnings estimates, that was lower than last year's. Okay, so you sit there and say 385 in the same period last year, they got 378 this year. So again, they beat, but it's a decline. Now, for those of you who sit there and worry about quarter-to-quarter results, remember, Home Depot is a big company, and they're going to be affected by what happens in the economy. The question I ask you is, do you think Home Depot will be around in the next 10 or 20 years? If the answer is yes, do you think they'll make more revenue or profit 20 years from now than they do today? If the answer to that is yes, the question then becomes, what's the reasonable price to pay for Home Depot stock? Now, we don't necessarily go over those in more detail here on this channel. On our main channel, we do. But for Home Depot, you have a great brand. You've got a company with a great return on capital, which means when they invest money in their business, they get a very high rate of return on it. These companies are going to be cyclical. There are going to be ups and downs. Don't find yourself just trying to jump in and out as cycles happen. Just remember that you're buying a great company at a great price, hopefully. But if you're paying a lot, now they're at all-time highs. Is that reasonable? I don't know. I mean, last year they made more money and their stock wasn't this high. So you have to sit there and understand these things and realize that every investment is the present value of all future cash flow. And that's why we made these tools so that our users and our community, our members of our community, can sit there, determine the right price for themselves to buy these companies at. Stock number 2. Guys, Shopify. Shopify absolutely is killing it today, up 22%, 23% now. 23%. Now, what's interesting is their all-time high was 176 exactly 3 years ago. And now they're at 110. And let's go look at their income. They are doing way more revenue now than they did back then. That's what I mean when I say stocks in the short run are a voting machine. In the long run, they're a weighing machine. Whatever's popular, it was extremely popular here, then it became unpopular, and now it's getting popular again. That's the thing to watch out for, okay? Now, Shopify reported $2.22 billion in revenue versus an estimated $2.15, and they reported 28 cents, barely beating 27.8 cents per share. So basically they matched their earnings per share, but they're up 23% during the day. Now let's go look at their earnings release to see why that may be. First line in their earnings release, Revenue growth accelerates to 26%. Free cash flow margin expands to 19%. That's a big number. This is a company that was having a hard time generating profit, but guys, this company makes it really easy for people to sell online. That's their big key. And here's a great metric, guys. This is from the CFO. Our 6th consecutive quarter of greater than 25% revenue growth, excluding logistics. Wow. 6 quarters in a row of 25% revenue growth. That's a monster stat, guys. And I look at a company like Shopify, and I look at everything they have going in here. And so let's look at an example of their balance sheet. This is a $140 billion company market cap-wise with basically the same enterprise value, which means they essentially have no debt on their balance sheet. Free cash flow of $1.3 billion in line with their net income. But here's what I like even more. Their 5-year free cash flow is $430 million a year. 5-year net income of negative $50. Now, you can tell their free cash flow is much higher now than it's been over the last 5 years. That's a big, important metric. And I love this gross margin of 51%. Guys, this company is a growth machine. Now, one thing I want to talk about, though, in our 8 pillars, the shares outstanding. Not as bad as I would have expected for a growing company, 5.9%. But you look at this company, they do revenue of $7.76 billion. That's a price to sales ratio of 18. A little rich for a company of this size. You know, another software business, like a stable software business like Microsoft, should probably sell for somewhere between 7 and 11 times sales. And that's a big range because it all depends on so many factors. 18 times seems like a lot. But again, this company's growing very fast. 6 consecutive quarters in a row of 25% revenue growth. I think it can justify a much higher premium. The question is, how much of a premium? Okay? That's why I ignore this 327 price to free cash flow number over the last 5 years. Because first off, their free cash flow is much higher. It's 3 times higher than it was before. So it makes this about 100, what the current one is 109. That's a lot. But again, it's a growing business. You have to understand how much they're putting back in the business that hurts their free cash flow. It's reinvesting to get higher returns. That's the big thing you have to understand with Shopify. So I think one of the reasons why they're probably up so much is their outlook. For the 4th quarter of 2024, revenues to grow at a mid to high 20s% rate on a year-over-year basis. Gross profit dollars to grow at a year-over-year rate similar to Q3 2024. GAAP operating expense as a percentage of revenue to be 32 to 33%. Now, stock-based compensation, $120 million. That's a lot, guys. And one thing I want everybody to remember is that is a factor in there that you have to sit there. That's part of dilution. A lot of people will take the free cash flow and subtract out this stock-based compensation for essentially the real free cash flow number. That takes a big chunk of that free cash flow, especially considering in this 3rd quarter, they generated $421 million in free cash flow. So they did that 120. It's essentially making $300 million in free cash flow. So that's something that a lot of people look at, which is a very important metric in your free cash flow metric. Guys, we love Shopify so much. We actually have our own merch store on Shopify. The link is in the description below. You can go in there and get cool gear like my nice little everything money quarter zip, a hat, something like that. Whoever buys anything today, we'll put it in a box and we'll sign it, including the quarter zip that I'm wearing right now, the nice white quarter zip that I'm wearing currently. Stock number 3 is Sea Limited. Guys, Sea Limited is a Southeast Asia company up 15% today. They reported $4.33 billion in revenue versus expectations of $4.09 billion and 52 cents versus 45 cents. So basically all 3 companies today beat on revenue and essentially beat on profit. Shopify was basically earnings per share was exactly even. Sea Limited, if you don't know, they have 3 basic divisions. 1 is gaming. 2 is online financial services, and 3 is e-commerce division. So this company has a lot of major growth potential, and they've really kicked it back up. And here's their earnings release right here. But one thing I want to show you guys, all-time high, 3 years ago, $372, 52-week low of $34. That's a drop of over 90% to the 52-week low. And I don't even know that's the exact low where the actual low was for this company. 34.87. Yeah, it looks like a 34.35 right there. So let's go look at this company's quarterly report. Guys, look at this. GAAP revenue up 30.8% year over year. Gross profit up 29% year over year. Net income of 153 million compared to a net loss of 144 million. Almost a $300 million positive swing to their bottom line. That's a huge number right there. EBITDA, 521 million versus 35 million before. In cash and cash equivalents were 9.9 billion, an increase of about $1 billion. Guys, I mean, I'm looking at this company and I'm sitting there saying, okay, we've got a company with a $72 billion market cap, between $78 and $82 billion enterprise value. That difference there is essentially the net debt. Now, what I love here is free cash flow significantly higher than their net income number here. 1.7 billion in free cash flow. So guys, I don't know much about this company, but this is a big earnings release and a big day in the market today for Sea Limited. So for those of you out there who are knowledgeable on this, take a look at it. But one thing I would caution you against, shares outstanding, big time increase. So they're diluting their owners. 29% increase in their shares outstanding in the last 5 years. Guys, that's a big, big number. Big number. And it's selling for how much? It is only selling for 5 times price to sales ratio with a gross margin of 42%. That seems not bad. So the reason I look at that is whenever a company is really growing, I like to look at their sales, their price to sales ratio. It's a way of me looking at it and saying, hey, what are they selling like relative to other companies with the same gross margin, with the same potential? Because when you can't generate profit or you're reinvesting so much that you can't generate profit, one way to compare a company to what it should be worth is looking at its price to sales ratio. This feels lower than it should be. And obviously it's hard to value it with such a big negative number in net income and such an inconsistent free cash flow number. Remember, as companies are growing, you got to be willing to pay a premium for it. Now, guys, on this channel, we have a big community. We have great software that can help you become a better investor. And we have a great $7 for 7 days, but we have limited spots every day. So if you're interested in getting this software, go sign up now for the $7 for 7 days. That way you can get access to it before the spots get filled. Thank you very much for your time.